Trump revisits tariffs on the world. Is this another volatility gift from the president trader? And the Fed keeps interest rates uncut, spitting in the face of the orange power that bees. All that and more on today's After Hours. Welcome to After Hours at Traders Post for Friday, August 1st, 2025. I'm one of your hosts, Tom Hartman, joined tonight by Peter, Exit Liquidity Hartman, to break down the madness. After Hours is your go-to live stream for sharp, trader-focused market commentary presented by Traders Post, the ultimate automated trading platform in the known universe. But more on that later. For now, I like to ask, how's it going, Peter? How's your week been?
Very busy.
Nobody cares because Mike Christensen on Price Action Live nailed it, Peter, this week. He's been trading diligently out in public in front of everyone from 9:30 a.m. Eastern Standard Time till 10:30 a.m. And he's been crushing it and got his first payout from prop firms. Account scaling. Way to go, Mike. Way to go, Mike. Does my jealousy know no bounds? Is my frustration at his success and my failure eating me at my core? Find out next Price Action Live on Tuesday. We've also added Friday to the list because it turns out that since, Mike, I haven't asked him, but I have to admit, I have to assume that because he succeeded on it, and he succeeded on it using Traders Post and the account scaling feature, that he's just eager to rub it in our faces that much more how much of a good trader he is than I am.
So you're doing Friday as well?
We're doing Friday as well. Tuesday, Thursday, and Friday. Fantastic.
Where do you guys find the time?
Well, we go on and off. So some of us will be on Monday, Tuesday. Other ones will be on Thursday, Friday, and that sort of thing.
I see.
And sometimes we only do half an hour. Sometimes we do an hour and a half. The issue is that, Traders Post, as you might imagine, is filled with traders. And the idea that we're not going to trade the open, that no one's going to participate in the open, is sort of silly. Not all of us are like our fearless leader and CEO, John Wage, who's perfectly happy buying Bitcoin when he's on the toilet and building the best automated trading platform in the universe. The rest of us see the market and we want to participate. It's pretty cool, though, because I don't trade the same assets as Mike does or as Trevor does, and so I feel like it's like if you let someone dance with your wife and they dance better, it was not exactly the same. They're doing a whole other dance. They're doing something else, so I could just appreciate their skill. If he was trading Bitcoin, I'd be furious. I'd be livid. All right, so guys. The market, volatility everywhere. We have Nasdaq down, SPY down, gold up, dollar volatile, Bitcoin down. It's been pretty interesting, pretty crazy, pretty all over the place. Usually the first week of August, not like this, but now we got like IPOs from Figma. We have moves on reddit.com that move at 14%. Like all kinds of crazy things are happening. And it makes us wonder about the future. And who do we turn to if not our fearless leader, Jerome Powell, to find out what's going on at the Fed? So
is it because it's summertime that you don't expect much to be happening in the markets? Is that why it's unusual?
Yeah, usually during the holidays in the winter or summer, people are away. There's low volume, and you sort of forget about it. There's a whole saying, "Sell in May and go away," and you come back around Labor Day. That's what you normally expect, and then you come back on Labor Day. People go, "Oh shoot, the economy's terrible. Sell the market," and then the market goes down. But we're getting like crazy volatility now. Now, is it that Bitcoin's down 30% and the Nasdaq is down 15% and all that sort of thing? No, that's not what we're seeing. But there is weaknesses showing up in so many places, and people are scratching their heads, going, "Why isn't the Fed cutting rates?" You might be thinking that.
Yeah, why is the Fed not
cutting?
Cutting. I mean, I'm beginning to think the Fed might be a little political. I'm just beginning to
Hey,
suspect that.
hey, no, don't do that. The Fed is independent and doesn't make any decision based on what orange people say or anybody else. Look, let's take a look. You don't have to take my word for it. What we're going to do is just take a look quick here at Danielle DiMartino Booth, who was a Fed insider turned market analyst, and she's fantastic. I love her. I've talked about her on After Hours many times. I want people who were in the belly of the beast coming out and tell me, interpret the tea leaves. It's sort of like somebody who, nope, I guess I shouldn't say that. Let's go with it's somebody who.
What were you going to say, Tom?
Let's go this way. It's like someone who was an ex-Christian who now goes like, this is what Christians think. This is how they operate. This is how they believe. There.
But before you do that, do you think it might be beneficial to, I don't know, show the charts of the market, show the indexes or something like that to kind of get a sense of what's going on now, or maybe later?
Yeah, we can take a quick look at that right now. So what we're seeing is, if we take a look here, we're seeing, oh my God, just this pullback here in the Nasdaq at the top left. We have the US dollar that bounced off a low over here, and then pulled back dramatically. We have gold futures that revived, and then we have Bitcoin that's fallen now to 113. I mean, who could have seen that come in? I think I sort of called that a couple of weeks ago that Bitcoin could go there, but then I also did say that Bitcoin could go to 150, and it didn't get there yet. That's one of the things I like to do, Peter. You call the low, you call the high, and that way, no matter which way it goes, you succeed. I learned that from a con artist book called The Confidence Game from Anna Kournikova, and it has served me well. So the two things I wanted to go over today, first is this idea of what are people saying as far as the what's going on with the tariffs are concerned, because the tariffs have come back on. And if you'll remember, the last time, if you head back to the chart and we look back at the last time we had the tariff fiasco, this was in March and over here. So we had this tariff fiasco over here where we had the price with this fall that happened in the Nasdaq. Let me just hide volume so you can see it. But basically, we had a sell-off of about 20% in the market, and a bunch of people, Mike included, but who's keeping score, thought that the market would fall even more after that, right? Because of the tariffs and the inflationary effects and the uncertainty and all that sort of thing. What did we see come April? Complete reversal, right? So the question here is, one, are we set up for another 20% down on the market, which would bring the Nasdaq down to 20,000? And will it V back up, which means well, why sell now if you're going to buy it back later on? What's the trade to put on? People are sort of confused. Plus, the tariffs now that are being put on are not as dramatic as the ones that were put on, that were discussed initially. We still get stuff like, we're going to put 100% tariffs on China. But so people are sort of like the boy who cried wolf, sort of like a tackle trade. If the market falls deep enough, then Trump will reverse his position. And so since we saw that before, don't sell off now. It's sort of like we don't know what's going to go on. We don't know what's happening. If we take a look at the structure of what's going on over here in the Nasdaq, we'll see here that we've fallen now to Trevor brought this up in Price Action Live. We've fallen to a previous high, so the July high, and we've cleared now or we just about cleared all the VWAP levels, the volume weighted average price levels for different weeks and different days. And so I would be of the opinion that we're not going to fall much lower, but if we do, that we'd be heading to the next level here at 22.4 for the Nasdaq. If you take a look at Bitcoin, we're seeing here that it completed its trip down to the VWAP levels here at 113.8. And so we're looking for potentially a bounce. Now, if we're going to look for a bounce, what we want to do is look at the dollar. Let's just head over to the dollar futures. So this is what's going on over here. Let's just hide some of these. And let's show you guys the 3-month trend. No, 1 month. Okay. So this is the dollar we're looking at. Well, these are dollar futures. And what we saw here is that the dollar fell near a trend level, and it bounced pretty dramatically back up to the 100 level. Now, you guys will remember over the last couple of months, Peter and I, Mike and I, we talked about how this 100 level on the dollar is a key level, right? When we come at it from below, we usually reverse. When we come at it from above, we can bounce on it. It's a pretty significant level, and it's been significant for basically a decade now. So the idea here is that the dollar bounced up towards that level, and look, we got a pullback here today that was pretty significant. Let's just zoom into a lower time frame. Look at that candle. These are volume size candles, and it went up to the 100 level and just completely pulled back.
Wow.
So the question here is, does that mean that is it just a pullback as we just hit resistance here at 100 and we're going to move lower? Or is just a mini pullback for the uptrend in the dollar that's going to continue? All right, that's a big question. If it is that we're going to fall lower, that they're going to cause the dollar to go lower, they're going to sell off the dollar, that is generally bullish for equities, bullish for crypto, bullish for tech, for financial markets. Pretty bad for the economy, but hey, bad for that. If it goes the other way and the dollar is bouncing, then we're headed to deflationary effects, which is bad for markets. So pretty bad for markets and bad for financial system. Because if we're in this channel here and we are headed higher, let's go to the weekly. This is the channel we've been tracking. That means if this is the low for this channel, that means the dollar can go up to 122. And I don't really want to be sitting here holding longs with the dollar going up to over there. That's pretty significant. That's pretty bad. This whole time that this happened was during the recession, the economic recession, with the whole inflation fears and all the different issues that we had. The market was down for almost 2 years. So I don't want another of these, but we'll see. Let's go take a look at what people are saying, though, inside of the markets. I brought up before Danielle DiMartino Booth, and she's always my go-to for interpreting the tea leaves. She is fantastic at that. So let's just hear a little bit of her interview on, this was her interview on, shoot, I forget what his name is. TDLR, right? TDLR. Let me just pull that up. You guys should definitely go take a look at this video. It's fantastic. She really runs through it over the next 22 minutes. We're just going to show a couple of parts to it, but go over there and give them a like on that video. So let's take a look. Here they talk about jobs to begin with. This is interpreting what Powell said during his press conference.
Substantial.
So how would you characterize the overall health of the labor market right now?
I think it is. I think it's on very fragile footing. It's never a good thing when the front page of the Wall Street Journal has a story about CEOs flexing because they're firing people and replacing them with AI and offshoring to a greater extent. Obviously, it gives your stock price a nice pop. But
so we're seeing that. We're seeing that companies, especially tech companies, are laying off employees to reduce their cost, right? To make them more profitable, and then we're getting the stock sometimes going up on it. So this is bad for the economy because you're increasing the unemployment, but good for the bottom line of the business. So it's this weird double-edged sword. Like, do you want a company to cut in order to be leaner? Do you want them to keep people on that they can't afford?
Uh,
Where's the trade-off here?
But that is kind of where we are. We're in cost cutting mode. We saw that in the GDP data. That rate in the first quarter to 1.9%. Every single recession in U.S. history has been led by declines in business investment. And we're certainly seeing that despite all of the enthusiasm and hope surrounding the big, beautiful bill unleashing expansion in the private sector, hiring in the private sector. We're not there. We're actually in a completely opposite mode right now.
I think part of the discussion around today's decision to not raise, or cut rates rather, was political. People wondering whether or not this is a politically motivated decision.
So just to remind people, the Fed's mandate is full employment, stable prices, right? And so if people are being laid off, that would be usually a signal for the Fed to cut interest rates, right? The idea is that cutting interest rates will increase the flow of capital because it'll encourage lending and business ventures and all that sort of thing. So she's saying, well, we're seeing all these layoffs. Why isn't the Fed starting to cut rates? But the Fed is pointing to, or rather, the Fed is relying on the idea that the stock prices for our assets are going up, and so things are fine. Even though the Fed says we don't take a look at the stock market, but they sort of do. So it's like, well, what's going on here? People are being fired by the thousands and thousands and thousands. Microsoft fired 9,000 people the other day. People are being laid off. Well, what's going on? Why aren't they cutting rates? That's where the political thing comes into play.
Decision to keep rates unchanged. Actually, there were two dissenters, Bowman and Waller. Take a listen to this question, Q&A. One
more question on the lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're going to...
So the dissents that are happening, when we get the Fed presser, we also get to see what the other board members, the Council of Elders for the Fed, for the monetary system, if they thought that we should cut or not, or raise rates. And there are more people than expected who wanted to cut rates, who thought we should cut rates. So that's the dissent that happened.
You're not going to talk about exactly what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
The discussion around policy was, the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people...
So they're saying that inflation is still a little bit too high, so we don't want to cut rates. That's what they're saying. All right.
Have been and still are. Two of our members felt that the time had come to cut, and that they, for the reasons that they're going to express, I won't tell you the reasons they.
All right. The two dissents came from runners-up to replace Powell. So what's going on here?
Well,
so the two people who dissented are two people who seem to be considered for a replacement for Powell. Right? Remember, Trump wants the Fed to cut. So you can imagine that in the political sphere, the two people might be dissenting, not because they think that the economy needs cuts, but because they're trying to become the next Jerome Powell. Ooh, spicy.
Yes, there is definitely politicking going on. There was an element of condescension.
Okay, anyways, there's that. And then let's jump to this idea here. He made the claim about inflation, that inflation is running above target. So they want to keep monetary policy restrictive in order to bring down inflation. Remember, Powell's been saying this whole time that the Trump tariffs will be inflationary because of the supply shock. That people have to rejigger things, make different purchasing habits, and the tariffs will some of the tariffs costs will be borne by the American consumer. This is all inflationary, and that's why he's not cutting rates. Okay, hear what Danielle has to say about inflation.
Let's go back to the FOMC meeting itself. So Powell said that both the labor market and inflation are at risk of deteriorating, and so. My question is, if he thinks that the labor market is going to potentially weaken or show signs of softening, then that means he's not cutting rates now because he really believes inflation is going to run up. I mean, his language was more moderated than mine. He thinks it's somewhat elevated. Those are his words. But how bad is inflation going to get to spook the Fed to keep rates unchanged if they think the labor market is going to deteriorate?
Well, it's interesting you asked that question because today the Cleveland Fed's new tenant rent index was published. It showed negative 9.8% over the quarter. Powell even mentioned once again market-based inflation measures, market-based PCE. And if you incorporate the Cleveland Fed new tenant rent index into the market-based core PCE, which he instructed us to do last December at the podium, then inflation year over year is running at negative 0.3%.
Which is significantly still higher than the Fed's 2% target. So what does this mean for policy?
Sorry, negative 0.3%.
Oh, negative. Oh, I'm sorry. I misheard you. Okay, negative. Wow. Okay, so
That's amazing.
policy error then?
Absolutely.
No.
Policy error. Look.
Okay, so that is. So she's saying if we just go by, so there's all kinds of different inflation metrics you can use.
Mm-hmm.
And the Fed loves to be squirrely as to what it's actually paying attention to. It always loves to pull up the metric that gives it allows it to do what it wants to do. So he was saying you should go look at PCE. Don't look at the CPI report. Don't look at true inflation. Don't look at any other stuff. Look at the PCE, personal consumption expenditure, and then do this modification for new tenant data. And then that's what we're going to pay attention to, presumably because back then it showed the number being higher than it needed to be. So Danielle is saying, hey, we do that calculation now, and inflation is not running at the above 2%, which we heard him say during the presser, that it's running at negative 3%.
That's unbelievable.
So this inflation is when you have a positive inflation rate and stable and increasing. Disinflation is when that inflation rate is coming down. So if you go from 2% to 1.9% to 1.5% this is disinflationary. Negative inflation is deflationary. Deflation means that money is being destroyed. And the Fed should absolutely be cutting to get the inflation rate up. Now, Trump has been claiming, and Bassett has been claiming, and all that the Fed should be cutting because we're not in high inflation, and we got to get back up to where we need to be. Now, there's all kinds of arguments if you think the Fed should be cutting or have control over the inflation rate at all, or what the true motivations of the administration is, whatever it is. What the Fed says is that if they want the inflation rate to be at 2%. So if you're below 2%, cut rates. If you're above 2%, raise rates. That's what they're supposed to be doing. And if, according to the measures, we're below zero, or negative inflation, then they should be cutting with both hands.
Well, why isn't someone at the pressers asking him why he's not including PCE in his calculations?
Because then you don't get asked for questions anymore, and you get escorted out of the room in future things.
No, that can't be it. Please
If we take a look at the chart, let me just pull something up over here. If we hit, pull my chart up.
Negative 0.3.
So let's say we're taking a look at. Show my screen here. Let's say we take a look at ISM. So ISM is. Oh, sorry, wrong one. Sorry, PMI. All right, so we take a look at the PMI. This, broadly speaking, could be considered the business cycle. So it goes up and down and up and down and up and down. So when it goes up, that's expansionary. It goes down, it's recessionary. Up is expansionary. Down is recessionary. Up, down, right? So this down over here was during COVID recession. It bounded up. We had that whole explosion up. That is, Bitcoin at all-time highs, meme stocks, stock market doubled what it was before, all that, GameStop, all that. And then we had the down of the recession because of the whole inflationary thing from in the 22, and then now presumably we're moving up. But as long as we're generally expansionary, when we're above this 50 level, when we're above 50, we're expansionary. Okay? So generally speaking, again, just like we were talking about before for the interest rates, if we're below this level, the Fed should be cutting. If we're above this level, the Fed should be raising. Right? The whole idea of the interest rates is that they are lessening the downside and letting the the good times roll longer and making sure that the hangover is not as dramatic. That's what they're supposed to be doing, right? And so over here we peaked above 50 for a little bit, and now we moved back down for consecutive months. Now we've been now lower than 50, and we're at 48 now and falling. All the economic, forget financial markets, so many economic signals are showing this massive weakness. People are being laid off, the ISM not rising, the dollar bouncing off the lows, signaling weakness in the availability of credit. We're even seeing the wobbles now within the financial markets reflecting this volatility. All signs point to cut rates, and they are not doing it.
Okay, but you're missing a big part of the story here, which is Trump's tariffs. Look, Trump puts on the tariffs and he does these wacky moves and these bold proclamations in order to, I guess, art of the deal the whole situation, not really letting people know where he stands, being the crazy person, he could do anything. Well, okay, that might work for him to some degree, getting these trade deals. He just got the trade deal with the EU, at least the agreement. But he's also in a deal with the Fed, and that type of behavior is causing them to be uncertain. So they don't want to do anything. Do they themselves now be blamed for going in the wrong direction when they don't know, are these tariffs August 1st? Here we are. Didn't tariffs for Canada start today? What's going on with the tariffs in China? What is he going to do? Uncertainty breeds this kind of just holding pattern that the Fed is doing, I think.
Except that the data is showing, one, there's actual net revenue happening because of the tariffs. We had uncertainty about the tariffs before, but I believe last quarter it actually showed that there was a surplus because of the tariffs. So we can't be saying that the tariffs are actually causing an inflationary effect because the cost is being passed on to the consumer.
Sure,
we're seeing a net increase in revenue.
Yeah, okay, I get that. All right. But we don't know what it's going to be, what's going to happen next month. We don't know if there's a delayed reaction to what's going on. We don't, didn't companies front run these tariffs and stock up so that the effect might be delayed right now? Like, there is uncertainty. You don't know what Trump is going to do with the tariffs. I don't know if I go to bed and wake up tomorrow morning, Trump is not going to do something crazy. As long as we have a wild card going, why should Jerome Powell and the Federal Reserve stick their neck out and do something that they might be blamed for being too early or too soon or anything like that?
Well, what you're actually bringing up, all those reasons, would actually be reasons for the Fed to cut. That uncertainty would be like, hey, we're not sure. Let's goose the economic system a little bit in order to make sure that we have a cushion. Right? All the things you just brought up are reasons to cut that uncertainty. Now, the reason they're using is that they're going Trump, tariffs, inflation, and so we have to keep rates steady. Not increasing rates, but keep rates steady. But then that has to be supported by the data. We're not seeing that. We're seeing deflationary effects throughout the economy.
Okay, so on that, and I'm just trying to draw back from years ago when I used to pay attention to this. Didn't we used to say that we want to be at 0%, not at 1%, not at 2%? Isn't keeping it stable at 0% what should be the status quo? Or is it because, like, why do we want it to go up to be, why do we want inflation or 1%, 2%?
Oh, you sweet, sweet summer child. That is so funny that's what you think. So
I mean, am I asking the right question? Like, do you understand what I'm referring to when we used to look at this in the past, that 0% means the Fed's not in the game? No.
You want interest rates. A healthy economy has interest rates that go up and to the right. You don't actually want interest rates to fall. Right? What you want is for people to be able to put money into their bank account, save their money, and it generates interest over time. And that's their savings. They could leave their money to their kids. They could grow it over time. Their working matters. When you have 0% interest rates, that means you cannot earn money by saving. You have to spend. You have to take risk in markets, in financial markets, or in businesses or whatever, in order to find ways of making money. One of the reasons why they lower the interest rates is to force people to go out and spend. Right?
All right.
Because
So
if your money is losing money over time, if the value of your money is going down over time, then don't wait till later to get that car you want to buy. Buy it now.
Right.
Because
So,
the higher inflation is causing the price of the car to go up in the future, so you better buy it now. Don't save. So it's actually unhealthy for an economy to have very low interest rates or 0% interest rates. Remember, we got the 0% interest rates because of the global financial crisis. They did quantitative easing. They lowered the interest rates all the way down to zero, and we just sort of stayed there for 15 years.
okay, so I have it backwards. What the interest rate when we were kids and you could put your money in a savings account and accrue interest, what was the interest rate?
When we were kids?
Yeah, like I
Well, like
remember growing up
4%,
and knowing
3 to 4%, something like that.
okay, so what we want is for interest rates to be high, to be at 3-4%.
Not high, just upward sloping. You want short-term interest rates to be 3%, 2 to 4%, and then you want longer-term interest rates to go up, so that it makes sense. The longer you're lending out money, the more risk you're taking, the more you should get paid for that. But what we have instead is that the whole curve, actually this way, the whole curve falls, like it's too low, it's too flat. And so the only way you can actually the regular person can generate the income is to spend their money, invest in things, trade in the stock market, take risks in order to get the cash. That's a sign of unhealthy economy.
That makes sense. Okay, that's right. You want it to be up to 3-4% or what have you, so that if there's trouble in the economy, then they can cut. It's bullets in the chamber that they can shoot, they can fire in order to goose the economy, incentivize people to spend now instead of saving. All right, I had it backwards. That makes sense.
Yeah.
All right, so if we're at negative 0.3, oh,
That means we're
I see.
deflationary. Money's being destroyed.
Yeesh. Okay, but that means that once they do increase rates, there's going to be a boom.
One, yes, but two, it looks like they might be too late, and it might cause a crisis
Oh my goodness.
in the economy. It might cause a crisis, and so if it causes a crisis, then it'll be like when they were too late with raising rates because of the inflationary thing. Well,
Right.
I should just mention that I believe they have it all backwards. Right? I think they should not be modifying rates at all. It should be set naturally by the markets at the different locations. It should be variable, and that the market decides. But barring that, just by virtue of what they're saying they should be doing, if they wait too long, what will happen is that, for example, DiMartino Booth explains it more in that video, and we've played it before from Ken Carson. What happens is that back 5 years ago, companies finance they were financing their debt at, let's say, 1.1 to 2%. So it used to be 0% interest rates. They refinanced higher than that, but they refinanced, and then later on, interest rates went up. We're at 4 or 5% now. So if they don't cut rates and force those rates down, when those people have to refinance the debt, when these businesses have to refinance the debt, they have to refinance it at a higher level.
Right.
That means a bunch of them won't be able to refinance it. And if they can't refinance that debt, then they have to close their businesses, sell the assets.
Ugh. And is there some type of national deadline for that, or people have different dates?
We're basically around that phase now.
Oh my God.
5 years from when it happened. And so the crisis that could happen is that businesses start closing, the unemployment rate could start shooting up, and people become reticent to spend money, and it just causes a recession for years. And it won't matter if they cut rates later on, because if it's too late, people go, I got too burned. I had to close my business down. I had to sell my home or whatever it was. And it'll take a while before they're like, okay, now let's go ahead and invest again.
What's the downside for the Fed to cut the rates now? Let's say they make a mistake and they shouldn't have, but they cut it. What is the downside?
That what they would say is that they would add to the inflationary effects of the tariffs, and we're going to turn around and we're going to have 8% interest rates.
And that would have what effect on the economy?
Inflation is arguably worse than deflation, because deflation eventually that clears. Deflation only continues insofar as all the risk within the system gets cleared out. Once everyone who can't pay anymore have to sell their assets, the debts get rejiggered, people are going to lose money, lost money, and that all flattens down. There's a base, and then from there, over time, people then take more risk over time and go up. If you have an inflationary environment where inflation is out of control, then what happens is that it eats into people's ability to make long-term decisions. So you can't borrow money easily. You got to spend money now, but once you spend that money now you don't have it anymore. The value of your pay goes down and down and down because it's not going to go up at the same rate. So your check buys less and less and less and less. It hurts the entire economy, and it's very painful. And then it could then eventually lead to a deflation anyway. Like it could lead to that collapse afterwards. So it's like inflationary or runaway inflation is like the worst of all things.
So it's still a safer bet to what the Fed is doing. It's still safer.
It depends what side you're on.
I mean, look, if we're going to steel man their argument, he's not insane for what he's doing. He's looking at Trump. He's seeing it as the environment is being unpredictable. There's this new ingredient, tariffs, or at least the way it's being used, that hasn't been used for decades, and he just doesn't know. He's cautious Jerome.
But he's adding volatility to the market. He's supposed to cause stable prices, but this actually adds volatility because people go, I don't understand. You've taught me this entire time. You've taught me for decades that if there's problems within the economy that show up in the way that it does, you're going to cut rates. And now you're not.
Is the general public demanding that Jerome Powell cut rates? I mean, not like left and right, but like the general public?
The economy? Like regular Joe Blow?
Generally speaking, are people demanding, hey, Jerry, what the hell are you doing? Cut these rates? Or is it split?
The people on Wall Street and High Street and in the know, yes. People like you and I who understand this. Regular people don't know how interest rates even work.
No, I mean the people who know how it's working, who arguably are nonpartisan because they just care about their
That's the key part.
What do they want?
The people who are nonpartisan go, hey, by what you said the rules are, you're not following the rules.
Right.
But what people in the markets, what we want is to be able to understand what decision the Fed will make. And even though the Fed says they're nonpartisan, we know that's not the case. And so we can bet on the idea that the Fed is not going to cut rates until a crisis happens. Okay, let's go take that trade then.
Right.
We'll take that trade. It's bad for the economy. Bad for the economy. I don't know. It's sort of like let's say you didn't have a job. You had a job, but you weren't making enough, and you went to go borrow money from your dad every month. You went to go borrow a bunch of money, and then one month that the father goes, "I'm not lending you any money right now." You'd be like, "Oh my God, my whole world topsy-turvy." He's like, "Yeah, but you've been going to borrow money this whole time. How about you do something so you don't have to do that?"
Right.
Well, you should have given me notice. Yeah, I get it. Should have given me notice. So it's like, I don't think the Fed should be raising or lowering interest rates. But if they're going to do that, then keep doing it.
Right.
All right. So I wanted to move off here to this last, the next story, which is what's going on with the dollar, because it's all well and good to talk about the economy and what should happen and the job rates and blah, blah, blah. But you need some sort of tool to look at in order to get a sense of what's actually going on. And if the dollar is rising, it doesn't matter what the narrative is. Do not be fooled by any narrative. If the dollar is going up, liquidity is drying, because the only way the dollar goes up is if people are buying more dollars and selling other things. I wish people understood it's just a supply and demand dynamic. The dollar goes up because people sell other things to get dollars. The dollar goes down because they sell the dollars to buy other stuff. That's why they're correlated. There's no way of selling the dollar and getting something else, like getting nothing. That selling has to happen somewhere, whether they're buying bonds like we're seeing, yields are coming down, people are buying bonds, people are buying gold went up, or whatever it is. You have to buy something else if you're selling the dollar. And if you sell your asset, they have to give you something in return, and that thing's going to be dollars. So that's where they're correlated, and that's where the correlation matters. So here we're going to hear Jeff Snider talk about the dollar surging higher and what that means for the rest of the world. All right, so this is a quick thing. You guys want to go take a look at Eurodollar University, great channel. We're not going to watch like a minute or two of this video just to give you a sense of the claim being made of the deflationists. Oh wait, wait, let me just make sure I'm sharing the right thing. 1 second.
While you're doing that, we have a question in the chat from I'm the Cloth. They say, off topic, can I use Trader's Post just for copying trades without having an automated script?
Yeah, absolutely. So this is a very clear, something we really want to clear up at Trader's Post. Trader's Post is about advanced trade execution. You don't actually have to have automated buy and sells. In fact, right within the dashboard of Trader's Post, you can just go ahead and submit a buy and sell signal, and it'll trade across all the broker connections, the crypto connections that you have connected. So the automation part, if you're thinking about automation in that there's a script that's running and it's generating buy and sell signals, while Trader's Post can help you with that, it's not required. Right? So you can absolutely send one signal in, even manually, and have it trade across multiple accounts. All right, let's hear what Jeff has to say about the dollar.
Getting sold. Suddenly the dollar is, and just like that, Sell America is getting sold. Suddenly the dollar is soaring higher as everyone remembers forgot how to grow, didn't actually go anywhere. In fact, yesterday's GDP report in the US confirmed as much. And so the euro, which was once soaring for all the wrong reasons, has suddenly turned around and is now plunging. More importantly, though, India's rupee is doing the same thing. In fact, I did a video 3 weeks ago telling you that Sell America was way overdone and that the euro, its primary beneficiary, was at risk of a sharp reversal, maybe even.
When he's talking about Sell America, he means sell the dollar or sell bonds. But now the dollar is going up and yields are coming down. When bond yields go down, that means the value of the bonds go up. When bond yields go down, it means the value of those bonds are going up. It means people are buying bonds if yields go down.
Because they don't have to incentivize people to, buy the bonds so they can lower the yield.
Exactly. They need it so much that they're willing to take a higher and higher price for the bond in order to get it, because it's more valuable for them to have the bond than not.
Cash. Here's what I said back on July 7th. The euro has soared against the dollar recently, but for all the wrong reasons. It has left the exchange value basically over its skis relative to practically everything else. And therefore, it's highly susceptible to a possible reverse, maybe even setting up for something like a crash. And in this case, and in this shape, it may not take all that much to trigger one. Now, Sell America isn't real, but many people, especially institutional investors, are trading like it is, getting way ahead of themselves simply because they're misreading the other side of April. And so it only took a few weeks to see that misreading of dollar mechanics. But what does that mean now that the dollar's demise has yet again been greatly exaggerated? It really isn't so much about Jay Powell either. In fact, it's more about why there were so many dissenting against him at yesterday's FOMC meeting. The fundamentals have not changed, and we're being reminded of that repeatedly as more and more data comes in. The dollar did not suddenly forgot how to grow. And if anything, the world is starting to remember again what those fundamentals really are.
When he's talking here about forgot how to grow, and that'll be it for now. You guys go take a look at the full video. What he's saying is that what we were talking about before, the idea that we had 0% interest rates for years. The idea is to juice the economy. But you could imagine there's diminished returns for that, right? If you use your credit card in order to shore up your income, well, you got to make sure that when you spend that credit card on something, that thing is productive so that it can produce more money in order to pay off that credit card. If you don't, then you got to go get another card, another loan in order to pay that credit card. Right? So what happened is that because interest rates were so low, and that's what was goosing up the economy, that the large institutional players were able to borrow money and hire more people and all that sort of thing. Remember, the 0% interest rate didn't make you and I able to go get loans or bonds any cheaper. That's not what happened. If you wanted to go the business, it's like, no, we're going to go lend we're going to lend money to the bigger players. But if you're a bigger player, you're able to start businesses and do investments and capex and all that. So, but what happens is that you get this diminishing returns where the productivity keeps decreasing. For every new incremental dollar that's created in that way from the credit card, you're getting less and less and less productivity. And if that happens, you need to borrow more and more in the future, and you get this debt spiral, right? Where you also have to borrow debt in order to pay the previous debt, refinance to pay the previous debt, borrow to pay the previous debt, and eventually that whole thing comes down.
There's like a ton of citizens in both, I guess, Canada and America, probably around the world, who know exactly what that's like.
That's right. So I'm going to talk about what this does potentially for Bitcoin and equities, because you might be asking yourself, hey, Tom, so then what's a trade? Does everything go down? Are we ahead for a crash and it's going to be a recession for 10 years? Or is everything going to go up? Find out after the break.
How tantalizing.
Ask yourself this. Are you making trading harder than it needs to be? If you're trading manually or still coding just to connect to your broker, yeah, it's time to upgrade. Traders Post lets you automate trades using signals from tools like TradingView or TrendSpider or even your own custom setup. It works with brokers like TradeStation, Tradeovate, Coinbase, and a bunch more. I've been using it myself, and getting started was smooth. The platform's clean, setup's quick, and once it's running, it just works. And when you're ready to scale, adding more strategies, plugging into prop firm accounts, or juggling multiple portfolios, Traders Post handles it. It's built to grow with you. Start your free trial at traderspost.io. Trade smarter, automate your edge.
All right. So the question here is, Tom, you've convinced me. There is a problem within the economy. Interest rates should be lower. People have to refinance their debt, and we have some issues here. What is going to happen? Well, two main things fundamentally affect the economy: fiscal policy and monetary policy. Now, if I were to ask you, Peter, does the presidential administration, Donald Trump or any other president, do they want the stock market to go up, sideways, or down?
Up. Always up.
Number go up. If I were to ask you, does the monetary policy, does the Fed, do the central banks want the value of collateral, value of assets, to go up, down, or sideways?
Up.
So any 2-year-old, including Peter, knows that that's what the two main parties want to happen, right? Inside of our system. If I were to tell you here, let's move to show my chart here. This is the S&P. What can you tell me about the S&P over time? What can you tell me about the Nasdaq over time?
It goes up and to the right.
What can you tell me about Bitcoin over time?
Up and to the right.
Single name stocks, anything tech. I wonder what happens to all these different things. What happens? What goes on? Are you noticing a pattern here? Oops, wrong one. XLI. Are you noticing a pattern? Do you think are you going to find that? You expect that I'm going to be hitting any buttons here and going to any charts and I'm going to see anything other than up and to the right?
SBFs, Luna. I don't know.
Exactly. Only things that are going to crash to zero actually go down. Everything else generally goes up and to the right. Why? Because over time, there's always the incentive for that to occur. And the amount of downtime that we have is no longer like what we had over here during the dot-com crisis, the global financial crisis, 1987 black, let me make this into a logarithmic chart, right? The Great Depression, Black Monday, dot-com, global financial crisis, Volmageddon, COVID, inflation that we haven't seen since the 1970s, and tariffs. You'll notice that it just keeps going up and to the right. Why? Because they need it to. So the only question is, how long will it go down for? And as you're seeing here, all the downs are, especially since the global financial crisis, have been, oh my God, I mean, barely. Nothing even to write home about. Right? Because of QE, machinations behind the scenes, change in reserve ratios, the Fed buying assets. I mean, if the GD Fed is going to buy the S&P straight out, that's what they're going to do. All right? We're talking about who's going to replace Powell and who can acquiesce fast enough in order to juice up the economy. We're not even talking about maybe we should pay our dues and just suffer the consequences of our overindulgence and our actions. That's not happening. So when people talk about the idea that, I mean, this wick is the Trump tariffs, this over here is COVID. The planet locked down, guys. That's COVID. So when people get worried for me about a protracted down, I go, okay, maybe that might happen. But I have nothing in history, short-term history, that's telling me that. So I'm long-term bullish assets. But it is true that if the dollar heads into its bullish phase, heads into a bullish regime, that we can get the dollar up, right? Because the dollar is the US dollar is going to be bullish until the end. In fact, it'll probably crash up because everybody needs dollars. All the nations need dollars. Everyone needs dollars. But we have to see what's going to happen over here. I suspect, and we're seeing this with the reversal over here, I suspect because the Fed has all kinds of different ways and the government has all kinds of different ways to cause the dollar to sell.
Mm-hmm.
They could do dollar swaps, they could do easing, they could ease the pressure for the dollar, right? Because the dollar goes up because there's a scramble for the dollars, and so if they can provide liquidity, could provide dollars to the market, then it'll go the price of the dollar will go down. So I'm more inclined to think that will happen than to think that now we have a change for the dollar. But we'll see. Jeff Snider thinks that we're going to go up and to the right. Now, if we do go up and to the right, and this is what I'm going to leave on. If we do go up and to the right, let's say the dollar does keep going up and to the right, Tom, can the stock market and Bitcoin and all that still go up while the dollar goes up? Exhibit A. Let's go ahead and overlay the DXY on this. And we'll see that they are inversely correlated, but there are times where the dollar goes up. That's the red line over here. Let me just actually change this to green so it's easier for you guys to see. For Peter's small mind, if I make it green, he'd be like, oh, I get that. That's the dollar. I'll change the...
Actually, I do get that. It's pretty good.
Yeah. So blue, stock market, green, dollar. Here, we have the dollar going up and the stock market still went up.
Yeah, but that was earlier. It went down while that was going up. It crosses it.
Yes, but it could still happen. Here, the dollar's going up while the stock market's going up. Right? So there is an inverse correlation here. The dollar's going up and the stock market's going up. So when the dollar goes down, equities move a lot faster, but it's not a given that the dollar up means that the asset prices will go down. Over here, this is over Bitcoin. Let me just make Bitcoin here logarithmic. So you can have bull markets that are happening within the dollar, while bull markets happen with the dollar while you have bull markets that are happening with assets. But with Bitcoin, it's harder. It's harder for that to occur because there's no productivity factor associated with Bitcoin. So this is why I'm more of inclined to believe that the dollar will reverse and continue its way down and later on go up at the end of the cycle, which I think will be in fall of this year earliest, than to think that the dollar is going to rise over here and that this is the top of Bitcoin and that Bitcoin's headed down to its cycle low. But we'll see what happens
that's good.
over the upcoming periods.
Sounds like good news.
Well, it's news. We'll see here.
So what's the trade?
The trade, as always, is long monetary and fiscal policy. We expect a crisis. The Fed always cuts instead of a crisis. It's definitely going to cause them to cut. So you wait for the crisis to happen. And when it does, you bet on the V back up. Because unlike the 1970s, when we had the previous bout of inflation and other sorts of things that are happening around that happened around the same time, we didn't have quantitative easing back then. Right. We didn't have all the money printing and the expectations that we have in the markets now.
And we didn't have the psychological effect that people have where they're just like, the debt, who even cares about the debt? 36 trillion or whatever.
Right. But we're on a nice edge here. There's a whole thing we didn't talk about today, the idea that part of the forced buyers within the markets are from passive investing. Michael Green has talked a lot about this. The idea is that most of the market now is through passive investing. People are just employed. They're putting money into their employees are putting money into the 401k. They're putting money in the 401k. It's being bought into the market. It just happens automatically. All these investment in things that people purchase, mutual funds, Vanguard funds, or whatever, they're just putting money every week that goes towards it. So if we have a huge bout of unemployment, then that money stops or slows down, and we can have an air pocket that causes selling to occur. And we can have this effect, this exponential effect that happens temporarily to the downside, and we get a massive price dislocation down to the lower end. But to bet against America, to bet that things will crash and stay down for a while, that has been a bet that has impoverished me every single time I thought I was smart enough in order to nail it. So I believe more that it's a sideways and then up than that it will be a down.
The Cloth in chat says, you guys are very informative. Have a great weekend. Well, have a great weekend to you too. I'm not very informative. Tom's the guy here. Tom and Mike are great here, but thank you. Appreciate that.
All right. Before we wrap up, there's a couple of things that happened during this week as well. We had the Trump tariffs are we're looking at 10 to 41% across the global market. So this is one of the things that's causing the sell-off. But we're going to get adapted to that, and I think things will get better after that. We have the jobs report that showed disappointing job growth. So only 73,000 increase and a rise of unemployment from 4.1 to 4.2%. Also, this is one of those reasons you're like, hey, why isn't the Fed not cutting? A 0.1% increase in unemployment is significant, folks. Is significant. Because you only get the rise of employment. There's a bunch of things that are happening before that rise in employment happens, right? There's slowdown in hiring. There is cutting of people's hours. So average number of hours worked. You have less businesses opening, more of them. And then you have the layoffs happening. So by the time it hits the unemployment number, it means this process has been going on for a while. And that even if they cut rates now, it's not going to change on a dime, right? All right, continuing the S&P, tech giants led the week's volatility. Amazon plunged over 8% on weak guidance, while Apple rallied 2% after reporting strong results, even though it fell down afterwards. Meta, Nvidia, Alphabet all finished lower. The Fed kept the rates stable at 4.25% to 4.5% for the Fed funds rate. The crypto market experienced a $150 billion wipeout following the Fed's decision to hold rates steady, and Bitcoin sinking below 115. Actually, we're down to 113 and bouncing. If we take a quick look at the Bitcoin liquidation map, we can see if we take a look at the Binance, OKX, and Bybit leverage positions, we have shorts now that are at $18 billion short versus 500 some a million long. We got massive downward pressure from the sellers, and I cannot wait to see them wrecked when everything turns around. But for right now, they are laughing. Headed back to market minutes. Coinbase shares slid 11% after reporting earnings that fell short of expectations, underscoring crypto sector weakness. Reddit shares soared 14% after a robust earnings report and upbeat guidance, bucking the overall trend in the tech sector. And finally, we had a Figma. Figma was launched, the design tool that became a publicly traded asset. Is that good? Is that bad? I don't know. But I like trading things. And as far as I'm concerned, if I could trade Peter, I would. Let's just hook everything up to the system. Let's get it going. That's what we want.
Can I use Traders Post to trade Peter? Because that'd be great.
If you become IPO'd, absolutely. Short Peter. Short him day. Okay, guys, that's it. Thank you so much for participating. This is After Hours. We love looking at the markets. You know, as traders, we don't like just watching the news. We want to trade it. That's what we're here for making money off of the joys and miseries that happen throughout the world. What else can we do? What else can we do? We'll be back next Friday at 4 p.m. Eastern Standard Time with more market news. But until then, we wish you, as always, happy trading. Say bye, Peter.
Bye, Peter.
Thank you.